Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at McNichol & Associates Asset Management.
Good morning. Just an update real quick on the Statesman. This is our newest multi-res development with Thompson Thrift, and then down into charts of the week. It is August the 13th already, so let's get down to it. So Thompson Thrift announced that they were going to proceed with the Statesman, which is a 340 unit multi-res deal. This is sort of right down the fairway in terms of our strategy in the real estate fund. It is a development project, so the pictures are kind of more computer generated. You can see here that the town of Gallatin is pretty much a suburb of Nashville, which is pretty hot in the residential space. So a lot of these communities have some pretty good acreage going on. This one's 21 acres, and again, 340 units. This is luxury product, so the computer-generated image there is really, and there's a variability in the pictures because I don't think they're all the same, but it's going to be nice. It's luxury product, looking at about a 65% LTV for the deal. Total pricing is just around $90 million, and in terms of the gross potential rent, about $8 million a year is what the modeling looks like. That's just sort of in terms of the monthly rent roll. And again, some nice glossy pictures there for your enjoyment. There are other sources of revenue which you can see here. So things like parking, the garages, various services, and then some contingency fees as well. So potentially another, call it $1 million in other income. And in terms of the sales analysis, looks like it should double in value over time. The projected exit cap is about 5.14, and this is more of a triple, just sort of stripping back that LTV out. So again, nice kind of, go back to this picture slide, Class A luxury product outside of Nashville. And Evan Pickering, my contact at Thompson Thrift, is going to set up a podcast where we can meet the team and dive into their strategy a little bit more. Essentially, they're multi-res developers. So with this area of commercial real estate, you want to be in a demographically hot market, but you also want to be mindful of the fact that if it takes a year or two to bring product to market, you just don't want to be kind of overly saturating a market, because you could get some absorption issues, and then it sort of plays on your pro forma rent roll. So that's sort of it from the alternative landscape, if you will. With regards to charts of the week, really, I think the proof is sort of in the pictures which are coming up, but he's basically saying there's not really much yet to be said in terms of the market creating a new crop of bag holders. But you can see here, so it did break out quite nicely. Like, it was below the 50-day moving average, so slightly maybe moderately, let's say, oversold, and then popped back up quite a bit. So we'll have to see if that's sustainable. Obviously, the beauty in these charts is can it last? But for now, this sort of zone around let's call it 7,600 should be the range of support, which is pretty good, because we're above that now. And so from a stock market perspective, that's a positive. The other thing too, this is a chart he brings up maybe once every couple of months. It's the 20-day exponential moving average, which is a little bit faster, but historically, when this index gets extended, this index being the S&P 500, it does usually result in a pullback in the near term. But in the bigger picture, he says these signals are bullish, and so over the past call it 36 months, it's happened a few times where buying on these dips is actually not a bad idea longer term, right? It doesn't always feel like that, but longer term, it's been a good place to play it. Just taking a look at the equally weighted calculation of the S&P 500, it's up too. So this rally looks like it's a little bit broader than just the usual suspects driving up the cap weighted index, which is really positive. So that's great. And then globally, stocks are looking pretty good. I think when I was doing the monthly, the only index that maybe kind of had some traction issues in July was Japan, and then I think Shanghai came off a bit. But overall, this particular ETF, the MSCI All Country World ex USA, is performing admirably well, and it's sort of on par with the S&P 500. That curved smile down below, is just starting to look up a bit. So that's pretty good. In terms of metals and mining, we talked about that in the monthly. And so, the big thing here is it did come off quite a lot from January until July. It was a pretty, rough patch for the metals and the miners. But, I think the prevailing view was that it was always sort of a bit of a reset, which can be healthy. And so last month you saw a big jump in the XME, which is the S&P 500's metals and miner index. And according to Andrew, I think he's thinking there is some room left to go. These metals and miners can easily sort of not just graze but break through that upper believe Bollinger Band in this case. So it could run a little bit more. But just remember, these can be as volatile as any asset class you can imagine. Speaking of volatility, it's there is none. So it's it's been the case that the VIX has been pretty dry lately here. It is kind of slowly in the lower panel, I guess kind of coming back up. So this is the second derivative, I guess. He has the VIX of the VIX. And you can see a trend forming where it's really a trend of I guess, higher lows, which is, not nothing, but certainly it'd be great if we could have a little bit more action in stocks. Maybe that's coming in September, who knows? And then in terms of the oil story, it's really uncertain, other than to say he feels pretty good about kind of, let's call it $70 as being the support zone. But as far as where we go from here, I don't think he really has a good handle on that. So that's going to be someone else's call. And then I think that's it for myself. I'll pass it back to Ken, I guess, if you're ready.
All right. Thanks, Joe. There's a couple slides that will be relatively quick. Canadian disclaimer for our Canadian investors first, just we're not offering securities advice. Contact us today. And then SEC disclaimer as well for anyone watching this video in the United States. Pretty quick. S&P 500, no box change this week. Same support lines as the previous week. New all-time highs this week. Really a less volatile week after a period of large heightened moves, I'd say. These big swings that we saw in end of June, early July, or all July, and then even the start of August when we've gotten this rebound. Over the last week, it's actually interesting enough been led by the two sides of the market that have kind of taken their turns at leading the market this year, AI and then energy. So last 5 days, those have been the best two performers. As a group's rebound in momentum over the last few weeks on the weekly and the monthly, it's up 12.5% year to date despite the pullback we've seen. And then the overbought oversold, second highest over the last 11 weeks. So some demand returning for these U.S. indices. Looking here, NASDAQ, 2-column changes, no box level change. It did create new support, but it is at resistance again for the fourth straight time at this level. Hasn't been able to break above. So this is a really key point to see if it can break above. And then obviously you can see those two higher blue lines that also serve as resistance. Really this week, the NASDAQ's obviously been led by the AI trade and actually SpaceX, which rebounded by about 37%. Despite the turnaround in the recent weeks, momentum remains weak on a weekly basis for the NASDAQ. And then the overbought, oversold was only about 12.5%, but that's still the highest since the week of June 19th. So you can think about how oversold it's been in terms of investors and the NASDAQ 100. It's up 18% year to date, despite that massive sell-off that we saw within the NASDAQ components in July. So really strong year despite that volatility. Dow Jones, no box change. It's 1 to 2% off all-time highs from last week on an absolute basis. You can see a number of support lines, a couple boxes lower. We overbought, oversold 54%. It's remained in overbought territory every week since the Iran conflict, which is a really positive attribute. Obviously, is that investors looking to lower their risk to equities? If they're looking for lower risk equities, are they looking at the Dow rather than a NASDAQ? I mean, the overbought, oversold would tell us that. So we'll have to continue watching that closely. TSX 60, not a lot of changes this week. Second straight week where miners have outperformed. Energy names also had a strong week. So kind of return to the commodities trade. We'll have to watch to see if that continues. And then overbought, oversold 83%. That's the highest since October 3rd as materials really look to rebound. So we're glad we obviously did not sell our exposure off there. VIX declined over the week. Mentioned earlier, decline in volatility. Created its second straight sell signal. And it looks like it's turning over and creating this negative trend for the first time in a few months. And mentioned that perhaps it was breaking to the upside, but it's completely reversed that small trend that we had. Looking at the bullish percentage charts, these two charts only moved up 2%, not a whole lot of changes. The S&P 500 as a whole remains more in bullish territory than the NYSE. Obviously, a lot more strength in the large cap names right now. And then the percent positive trend, you can see here, I said the Dow had a better setup technically amongst the US indices. This is kind of coinciding with that. 82% of the Dow's components trading in a positive trend, 70% of the NASDAQ, quite a large discrepancy. We're going to continue to watch that, especially with some of our value exposure, just as a value proxy. Toronto Stock Exchange, no changes here, so I'll flip through those really quickly. And then the asset class rankings, a couple moves within the sectors. Tech lost a number of buy signals. It's lost over 80 buy signals in the last month and a half. Basic materials actually moved up for the first time, I think in 4 months. So really nice move there. And then energy moves slightly lower. With real estate also moving much lower this week. So a lot of changes there. This is just the semiconductor ETF, which turned over and created its first buy signal since June after 4 sell signals. The ETF actually regained near-term market relative strength relative to the S&P 500. It's now the score of about 4.5 out of 6, which is really positive. And a large move over the last, we'll call it 3 weeks. But there is now a number of resistance lines that it will have to break through. But perhaps this recent breakout that we've seen into a buy signal is encouraging for some investors, but we'll have to continue to watch that really closely. This is the semiconductor index bullish percentage chart. You can see it's sitting at 54%. Well off this year's highs and well off really the last 2 years average. You can see we bottomed at 8%. That's the first time that's happened since a brief period in the tariff sell-off last year. These are the semiconductor index's forward returns after it reverses off a bottom of 8% or lower. You can see a number of these obviously in the dot-com era, a number of them in 2008, one in 2022, and then the tariff tantrum. So I'm not saying there's a huge sample size of information here, but you can see the median returns and the average returns over those periods, and actually the 6-month and 3-month return not that positive on an average basis, and on the median basis negatives for the semiconductor index. So perhaps that's a little foreshadowing for how semiconductors are going to perform through the end of the year. Another chart that just talks about all-time highs, kind of a bubble. Everyone is all in on this party. At the end of the first quarter of this year, households had 46% of their total financial assets in the stock market. That's 19% higher than it was in the dot-com mania in 2000. Household wealth is completely tied to the stock market. That's a quote from Elliott Wave International's financial forecast. But you can really see here the percentage equity holdings as a percentage of total financial assets, just how exposed investors are to equities right now. And more than double the low from the credit crisis. Obviously, that is to do with the market's pullback, but nonetheless, extreme levels. Next slide kind of talks about the bubble as well. This is the South Korean index. South Korean equities have really never traded this cheap. The forward PE ratio is below 5x. That's the lowest level in 20 years. Then that's roughly half its long-term average of 10 times. You can see on this slide to the right. The index has dropped about 30% from its peak, following a 39% drawdown that marked its deepest decline since the financial crisis. Obviously, that's collapsed valuations, and it's really being driven by expectations of cooling demand for semiconductors and memory chips. Obviously, South Korean index heavily tied to the AI trade with the likes of Samsung. The last time, obviously, markets priced in this shock of a magnitude was during the global financial crisis, when earnings actually fell 45%. So perhaps this is a bit of a foreshadowing how earnings look and how investors are looking at earnings for some of these semiconductor companies. But really interesting. Obviously, we have exposure to South Korea from a couple of years ago. We've obviously maintained that position, trimmed it. It's still up 72% year to date, despite this pullback, and we've kind of seen it rally off its bottom. Attractive from a valuation standpoint. Obviously, earnings with the semiconductors a big question mark, but the technical picture is really showing major improvement in recent weeks. Scoring at a 3.7 out of 6. Price target's about 214, so actually right at the all-time high that we saw back in June. So something we're going to really watch closely. Now, moving beyond kind of the tech trade, semiconductors, looking at Charlie Blow's slide here that tracks the rolling 12-month interest expense on the U.S. public debt outstanding, sitting at about 1.3 trillion. When you compare that to April of 2021, it's 3 times as high. That's becoming more expensive. The printing is going to have to continue. They're going to have to manipulate inflation and interest rates. I think this is a bullish, obviously, piece for owning gold. This is obviously China's gold ETFs racking up 14 days straight of inflows after a number of months of outflows. I think there's a continued rotation, whether it's North Americans, Asian investors, European investors, into non-US dollar assets to hedge some of that uncertainty, some of that inflation risk, some of that, obviously, the properties of gold store of value. And it's obviously not just central banks, it's retail investors, it's some institutions. And I think we're going to continue to see this rotation of capital into gold and even other precious metals. Now, this is Tether. They're continuing to add gold. They own about $18.8 billion worth of gold, about 146 tons. Their gold holdings have more than doubled since the first quarter of 2025. They are the largest known private holder of gold outside of central banks and government. And in the first half of 2026, there are only 4 central banks who bought more gold than Tether: Poland, Uzbekistan, China, and Kazakhstan. Obviously, we've seen a bit of a gold correction, but we're seeing this demand from other places other than central banks, which we've been talking about for a long time. And obviously, physical demand for the metal in terms of an input in industrial properties. So obviously, what does that mean? This is just a relative strength chart of gold versus the S&P 500. You can see these multi-year periods. This chart actually goes back to 1927, so it's no surprise. First few years all the way up until like 1933. I think it starts in 1928, excuse me. That gold was outperforming the S&P 500 and had that relative strength. But you can see every period where gold really outperforms the S&P 500, it lasts for 5 to 6 years. We've only had about 3 years during this cycle, and we are at the potential. Dorsey Wright highlighted it when you zoom in on this chart of seeing a reversal after gold's obviously pullback this year to start the year. So really liking those charts. Gold, the technical picture improving, the fundamentals are all there and they remain intact. So we'll have to continue to watch that really closely. And then this is just the final slide. This is U.S. copper shipments, which surged on the threat of Trump tariffs, obviously, from getting copper from other warehouses elsewhere. We obviously think this is just the U.S. stockpiling copper, which remains in a structural deficit. If those tariffs are put into place, expect the amount of copper shipped into the U.S. to tank for a few months. And then you're going to have to see probably 2 different market prices, one within the U.S. and one within on the London Metals Exchange, where you're going to, obviously it'll take a couple of months to balance those two out, just with the tariffs and the lack of imports within the U.S. if those tariffs were to be put in place. Now, this is just a SpaceX chart. This is another one of these AI images that I created on Grok, actually. I'm not sure if the numbers are precisely accurate. I know as of 2 days ago, I think SpaceX's shares were up about 37% over a 5-day rebound, but just highlighting the massive rebound that shares have gone on after kind of tanking after the first 2 or 3 day pop that shares have been on. Obviously, the sell-off really being driven by the unlocking of almost 1 billion shares. And we're going to continue to see that, and I expect share price volatility to continue to remain heavily elevated, especially as more and more shares come to market and demand might remain soft. And I think that's it for me. So I'll pass it back to Sean.
Okay, this is a macro overview for August 13th. Long biased exposures, things in the SPY, triple Qs, and GLD are looking good. Adding to those, as mentioned by Joe and Ken, the VIX is getting to the bottom of its distribution, and I like that. I'm adding some VIX exposure today via futures. Don't really have any short exposures on at the moment. Crypto, just minimal exposure. Things are just not working out in that space. We're not into the halving cycle, so I'm just advising people steer clear for now. Asset classes, the US dollar is, pretty quiet over the past week. Net. Gold is up. We've liked gold. We've seen a breakout. Bitcoin and Ether just kind of bouncing around against the US dollar, but nothing good happening in the crypto space. Crude up 12% over the past week. We just got a lot of noise coming out of the Iran conflict. Nothing getting sorted out there. Strait of Hormuz almost at a full stop again. I think the Iranians have the potential to wait this out as the U.S. depletes both their strategic reserves to keep spot prices down in the U.S. as much as possible, and apparently munitions. Economics, slow and steady. We're seeing the Fed continuing to speak hawkishly on inflation, but they had a good print both this morning and PPI came in a touch softer than expectations, and the CPI was, a little bit less than expected. The employment numbers were pretty good, like net in terms of unemployment, but that's because people left the workforce, and we had a print of minus 24,000 jobs. A little concerning. Trump is going into midterms. He's got to get the people thinking better of his role in the economy. The growth number coming out of the Atlanta Fed makes no sense. Just ignore it. Like, we're looking at 2% growth as kind of the expectation right now, which is still, lagging inflation. So not a great look. Are we in a recession? Certainly not. And the big movers, commodities, housing, and the consumer, we're just seeing turbulence and a fairly tepid consumer in terms of house buying with low confidence, right? That being said, retail sales are still pretty decent. What has changed in economics? In the past week, rate hike expectations are still there for 2 hikes, but they've been pushed off. The market's still currently pricing in, 1.5 to 2 net hikes over the next 12 months, but they're pushing off the timing. Now, I thought the other day about the misery index of inflation plus unemployment. We're in the middle of the distribution, and that's supporting mild policy moves. The market loves when things are stable, and I think that's why we're seeing the VIX dip down here into levels, that are among the lowest over the last 5 years. When we look at the misery index, you can see in the lower panel the distribution of returns, and this is, I believe, monthly data. Yeah. Over a very long period. We're kind of in the middle of the distribution. That's where the market likes to be. Things aren't overheated. They're not like, in the doldrums. So this is overall supportive for a reasonable, sharp environment at the bottom of the capital structure of companies. Like equities is a decent place to be right now. The US dollar has been going sideways over the past week. We still think that the administration wants a lower dollar, and certainly, the monetary situation, the fiscal situation looks like we are going to get it over the long term. Although there's going to be this push-pull back and forth between a flight to quality if a risk situation arises, in Iran or in the Ukraine. The yen, we had that massive intervention, a huge move for the currency. And you can see these days of negative red bars. Like we've got 1, 2, 3, 4 just in, 2026. Every time the broader market simply says, okay, you intervened, and now we're going to get back to business, and we are going to see a weaker and weaker yen. Now, why does that matter? At some point, Japan is going to have to start selling more of its treasuries, the U.S. treasuries, to buy oil if we stay at, $70 plus, as many people are expecting through 2027. This is not what the U.S. wants to see when they have a wall of financing to do. Gold is up. A couple of weeks ago, we noted the base. We put the yellow box around it. We saw that it broke out a little over a week ago. That trend looks to continue, although things are a little quieter, and that's on the back of the U.S. dollar also being a little bit quieter potentially here. Oil continued chop. Not much more to say there. Just follow the war. Rates very, very quiet net. I would say the one thing I'm going to be watching is Oracle. If a company is going to break down because of the AI spend and the AI trade and things not working out as we expect, it's going to be in Oracle. The S&P 500, we also noted a kind of a topping distribution having formed, and then we broke out of it again a little bit over a week ago. The Markov model that we built for the triple Qs is saying we're in a sideways state. So we've just broken out of definitely a sideways state, and we will see if it holds. I think it's got potential to hold, although the breakout was built on the earnings of, not that many companies and the biggest companies. But as was noted earlier, the breadth is there across the S&P 500 to see continued participation. Equity overall, good conditions. We've got trend indicators being positive in the S&P 500. Breadth is good. The VIX term structure is normal, upward sloping, and the spot VIX is below the front month. We're at like 14.43, 14% VIX. That's pretty good, guys. Overall, we're looking at a very normal forward environment for the Sharpe ratio. I look at the S&P 100 breadth. These are the bigger companies that drive the index. And across, 20, 50, 100, and 200-day moving averages of the stocks being above their moving averages, things are looking good with 70% plus participation. Very supportive of, the current market pricing and potential positive momentum. The equity regime right now is sideways. It's day 9. That's a fairly long period for a sideways move. On weight, the probabilities for the next 5 days are like 80%. We're going to be sideways or back into a bull market. Good time to be in equities. Crypto, not a good time to be in the market. It's just faltered as a debasement trade. Until the Fed gets back to looking to ease, this trade is just not going to work, right? There's very little need for Bitcoin in the current world. Stable coins have replaced Bitcoin in many ways. It's lost the imagination of literally every institutional investor that I talk to. Again, we've seen this broad downtrend. Are we forming a base? Possibly, but we need a catalyst. And the catalyst was supposed to be the Clarity Act. That's been pushed off.
Very good. Chris, do you have any comments?
Sure. Thanks, Luke. Sean covered a lot of great points there. I did want to touch on, maybe I'll touch a bit more on rate hike expectations. On the Reuters models, futures-based models that they use, they've got no hike in September. Coin flip 50-50 in October, but that's right before the midterms. So that's unlikely. Interesting enough. And also the data point that the Fed's going to be, they have one more CPI and PPI before the September meeting. So that's going to be pretty important. I mean, both those numbers tick down but not by a great amount. I mean, they're still, way, way above target. So trend is good, although very, very small moves. Surprisingly in Canada, futures markets are saying 2 hikes in 2027. So in Canada, I guess that's reflective in the Canadian dollar right now. We're seeing a pretty strong rally. I mean, we've had about a 2% rally so far, this month. And, I guess, looking at the 12-month bands, Canadian dollar, could rise up to 73 and a half. It's now 71.8. So that's another further move that, could happen if you look at the technicals. We're having a reasonable rally in bonds. I think that sentiment had hit a really extremely negative level with the blow up of the hedge fund in the U.S. I mean, that I think caused a fair amount of turmoil in the market. And, I think, we'll wait and see. I mean, this Kevin Warsh's strategy of, taking the market signals as opposed to forward guidance, it's sort of a bit playing into his hands. But I hope people don't think he's a genius if the inflation numbers come down, because they really haven't come down that much. And he sort of put his line in the sand at 2%, and CPIs, 2.5, PPIs are over 3. He's got a long way to go before, people start saying that, he's the new genius head of the Fed. So we will see, I guess, in September. On that note, I'll pass it back to you, Luke.
Well, thank you. Everybody have a great day.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit mcnickelasset.com to learn more.